Most traders lose money because they treat the market like a casino. But what if I told you that certain patterns have a mathematical win rate of over 80%? Today, I'm stripping away the vibes and giving you the cold, hard data. These are the top 5 highest probability trades in 2026, backed by over 30 years of historical performance and modern-day backtesting. Trade number 5, the ascending triangle. Probability, 83%. Starting off strong at number 5 is the ascending triangle. This isn't just a pretty shape. It's a visual representation of buyers eating through a supply zone. The setup, a flat top resistance line with a series of higher lows pushing up against it. The stat, in 2026 backtests, when this occurs in an established uptrend, it reaches its price target 83% of the time. Pro tip, wait for the volume spike on the breakout. If the volume is low, the probability of a fake out increases significantly. Trade number 4, the bull flag. Probability, 85%. And number 4, we have the favorite of momentum traders, the bull flag. This is what happens when a stock goes parabolic and then takes a quick breath. The setup, a sharp vertical move, the pole, followed by a tight, downward sloping consolidation, the flag. The stat, this pattern currently holds an 85% success rate for reaching its measured move, which is the length of the pole projected upward. The key, the flag portion must be orderly. If the consolidation is messy or drops more than 50% of the pole, the trade is dead. Trade number 3, the bearish 3-line strike. Probability, 84% to 86%. Number 3 is a candlestick pattern most people ignore, the bearish 3-line strike. Despite the name, it is actually a bullish reversal signal. The setup, 3 consecutive bearish, red, candles that trend downward, followed by one massive bullish, green, strike candle that opens lower than the last candle, but closes above the open of the first candle in the series. The stat, according to Thomas Bulkowski's research, this has a historical accuracy of roughly 84% in predicting a trend reversal. Why it works? It represents a bear trap where sellers are exhausted and a single whale-sized buyer wipes out 3 days of selling in one move. Trade number 2, the double bottom, the W pattern. Probability, 88%. Our runner-up is a classic for a reason. The double bottom is the ultimate sign that a floor has been found. The setup, price hits a low, bounces, returns to that same low, and bounces again. It looks like the letter W. The stat, 2026 data, shows that when the second leg of the W has bullish RSI divergence, the probability of a successful reversal jumps to 88%. Entry, don't buy the bottom. Buy the break of the neckline, the middle peak of the W. Trade number 1, the head and shoulders bottom. Probability, 89%. The king of high probability trades. The inverse head and shoulders is the most reliable structural formation in technical analysis. The setup, 3 distinct troughs, a left shoulder, a deeper head, and a higher right shoulder. The stat, modern backtesting across Forex, stocks, and crypto places the success rate at a staggering 89%. The logic, it shows a definitive shift from lower lows to higher lows. It's the moment the market psychology officially flips from fear to greed. The fine print, don't skip this. Now, before you go all in, remember, a high probability doesn't mean a guaranteed win. Even an 89% win rate means you will lose 1 out of every 10 trades. If you want to keep your account alive, follow the 3-5-7 rule. Risk no more than 3% per trade. Maintain 5% max total portfolio exposure. Aim for a 7% minimum profit target to keep your math positive. Which of these patterns do you see most often in your charts? Let me know in the comments, and don't forget to hit subscribe for more data-backed strategies. Happy trading!